5 stocks I'm buying now, December 2023 edition. Welcome in, folks. I am about to get into the 5 stocks and I'm very excited to buy throughout the month of December of 2023. Why I'm bullish on these stocks. We're going to go through the cases. I hope you can learn a little bit about these companies, but also kind of learn a little bit about my thought process in regards to buying stocks and finding, companies that I believe are going to do very well over the coming years at a very attractive valuation. So appreciate everybody joining me as always. Thank you so much for being here. If you enjoy these videos as much as I enjoy recording them for you guys each and every month, then smash that thumbs up button. That definitely helps us out in the channel. Make sure you're subscribed if you're not already subscribed. And other than that, folks, I just want to get straight in this. If you want to apply to join my private group, pin comment down there. That's to get access to all my courses, the 6- and 7-figure Discord chats, all that good stuff. Okay, that's pin comment if you want to join us in there. All right, first stock up of the 5 stocks is a pretty shocking one, I'll be honest. Alibaba. Yes, Alibaba, an absolute horrible stock the past 5 years. And I am actually looking to start a position in Alibaba during December. Yes, starting a position, okay? Let's first address the elephant in the room before we talk about the actual company, okay? There's the elephant in the room, which is China and the U.S. The relations between China and the U.S. have, I would say, deteriorated massively over the past, I would say, 5 or 6 years or so. China and the U.S. used to be very close, and I would say starting around 2016, 2017, relations started to weaken between the two countries, and they got weaker and weaker and weaker until they finally troughed very recently, and we are finally up in a good direction in terms of U.S. and China relations now at this point in time. Major development happened here recently, okay? And the major development is, at the end of the day, China and the U.S. realized they need each other heavily. We need each other for different reasons, but we absolutely need each other in the debt markets, in the business community, in getting along, because the more China and the U.S. fight, the more it's going to hurt both countries at the end of the day. You could say, well, maybe one country's hurt more than the other. That's a fair debate. But the bottom line is the more these countries are battling and going apart, the more each country is going to be hurt because we both need each other tremendously. And I thought the best example ever just happened a few weeks ago, okay? This was a game changer. Listen, President Xi in China hadn't been in the United States in like forever. It has been so, I can't even remember the last time Xi came to the United States. And he finally decided to fly over here. The fact that he was on U.S. soil for quite a while and spoke to not just politicians, but spoke to all the big tech companies, asked what China could do better, I can tell you that was like the biggest thing, okay? The second thing I thought was huge was they cleaned up San Francisco. They cleaned up San Francisco. Like, people like that have been living in San Francisco have been like, where's this been at, okay? The fact that the United States, we rolled out like that for them. The red carpet. We cleaned up San Francisco. Like, they don't even clean it up for the residents. Like, holy smokers, that's no jokers. Huge development there, okay? The bottom line is these folks have realized, damn, we need each other. We, all this fighting back and forth, it's hurting both countries. And so my belief is U.S.-China relations only get better from here for the next probably several years at this point in time, okay, which bodes very well for, obviously, Chinese stocks. Now, if you look at Alibaba, the business model is very similar to somebody like an Amazon. They have some differences in kind of how they do business versus Amazon. But if you think about Amazon, you think about a conglomerate. You think about the e-commerce side. You think about AWS, the cloud business, which is arguably the most important component to Amazon, the company, right? Obviously, I'm a big shareholder in Amazon. It's my 3rd biggest stock in the public count. If you think about Twitch, it's owned by Amazon. If you think about Whole Foods, it's owned by Amazon. Their advertising business, like Amazon's a conglomerate at the end of the day, right? Alibaba is very similar. A little bit of differences here and there, but at the end of the day, Alibaba's a conglomerate. Now, this company's growth rates are still pretty strong considering the Chinese economy has been pretty weak. They shut down, they were facing shutdowns for like 3 years. Versus the United States, we got over that pretty quick. China, they did not, okay? And so if you look at their main component business that most people know them for, Taobao and Tmall, they had about 4% growth in this most recent quarter. As far as their international business, that's booming. Their international commerce business was up 53% year over year. The local services group was up 16% year over year. Their logistics network was up 25% year over year. Now, their cloud business has been really weak here recently, which Amazon Web Services also was very weak the last several quarters, if you look at Amazon over the past 3 quarters or so. So the whole entire cloud business has been very weak, pretty much worldwide for the last few quarters, but I do believe that's going to get in a lot better place in 2024 and beyond for not just companies like Amazon, Microsoft, Google, but also companies like Alibaba. So that 2% growth rate, I think, is going to accelerate quite dramatically in 2024 and in future years. The digital media and entertainment group had about 11% growth, so overall revenues were up about 9%. Now, income from operations were up 34%. So the thing you understand is the weakest segment, one of the weakest segments was a retail business, right? Well, that's not always the biggest money maker. Some of these other faster growing segments actually are much bigger money makers. So their income from operations, obviously flew to the moon for the company, up 34% year over year. Non-GAAP EPS was up 21% year over year. So obviously over a double up of what revenue was up. So that's a very good sign for a company. And so overall, when you look at Alibaba across the board, obviously it went from taking big losses on a GAAP basis to now big profits. It's been a night and day difference, right? Now, look at the balance sheet for Alibaba, okay? They're sitting on about $33 billion of cash. These are U.S. numbers, by the way. If you look at the investor relations page at, let's say, Alibaba, it has it in Chinese currency, so it's a lot bigger number because U.S. dollars, to Chinese conversion is about 0.14, 0.15, somewhere in there. So about $33 billion in cash equivalents, about $45 billion in short-term investments. So they are loaded with money, just like the big U.S. tech companies are. They have about $21 billion in long-term debt, but when you're sitting on that much cash and short-term investments, I mean, they could pay that off tomorrow and still have so much money, right? That's a cake number there. Now, check this out. Total common equity. This is very important. $141 billion, right? Check out their entire market cap. Their entire market cap is $190 billion. Now, if you look at most big U.S. tech companies, you're going to find many of them have anywhere between, if you look at what they have in stockholder equity versus where their market cap's at, their market cap's usually 5x to 15x bigger than whatever their common equity is. Now, if you look at Alibaba, we're talking about only what? I mean, that's not even a 50% up number there. It's far less than that. That's incredible. So Alibaba is insanely undervalued right now. If you look at the forward P, it's trading at a forward P of 8 times. I mean, it's just beyond dirt cheap for a growth company. At the end of the day, Alibaba is a growth company, folks. There's no debating that. You look at the revenues, and this has even been a weaker economy for China. I am a believer in the Chinese economy over the coming years, especially if they get U.S. relations in a lot better place. So when I look at Alibaba, I see a dirt cheap company. I see U.S.-China relations only getting better over the coming years, and I think this is a huge steal deal. And I say, for the first time in years, Chinese stocks are actually able to be owned again. But if I want to play in Chinese stocks, I don't want to play in random ones. I want to play in the big dog. And the big dog is Alibaba. Okay, that is the big dog. So the bottom line is, Baba can come on out of the jail cell now at this point in time. You served your time. You've been in there for the last probably 5 years. In 4 or 5 years now. Literally, Alibaba's been in the jail cell for at least 4 or 5 years. Alibaba can come on out now at this point in time and come out to play. And I think it's going to be a pretty grand time, and so that's why I want to get a position started here and build that out. Now, will I build it into some massive position like my Meta position or Tesla or Amazon or Palantir or Elf or companies like that? No. Not looking to take that big of a risk, but could I build it out to 1 to 3% of my portfolio? Absolutely, okay? All right, guys, that's first stock up here. Second stock of these 5 stocks that I'm planning on buying in December of 2023. Everybody should know this stock was going to be on this list. Every person watching this video right now, you should know this stock was going to be on the list, okay? Because I've been buying it heavily the last several months. What stock is it? Say it with me. PayPal. Yes, PayPal indeed, okay? So PayPal is starting to roll. The stock's up over 16% in the past month. I'm saying, please chill. I'm not quite done buying you. I'm getting close, but I'm not quite done buying you, PayPal. So chill a little bit here. I need to buy more shares, okay? Where I want to start with PayPal is Alex Chris, latest conference call, knocked out of the ballpark. Man came in, took charge. He's going to be much more transparent than the old management team was with the numbers. This man comes from Intuit. Intuit's one of the most loved companies in the entire stock market. Literally, look at Intuit's returns over the last 10, 20 years. It's going to shock you, okay? He understands, like Intuit, to put this into, and he's one of the most important people at Intuit the last 10, 15 years. To put this into context, Intuit's stock in the last 15 years has gone up more than 20%. 11 of those 15 years. and only gone down once in the last 15 years. What Intuit's done has been incredible, and Alex Chriss is a huge component of that. If not, if he's not the biggest component, he's certainly one of the biggest components of Intuit's success over time and understanding how to build a great company across the board, okay? Now, when it comes to PayPal specifically, there's a magical business model because they have three components to their business, and that's why it reminds me so much of Meta. Valuation basis, but also like having three big businesses. If I think about Meta, I think about, which is the biggest position for me in the public account, right? I think we're up close to $400,000 in that position. If I think about Meta, I think about Facebook, I think about Instagram, and I think about WhatsApp. If I think about PayPal, I think about PayPal, Venmo, and Braintree. Three huge businesses. Now, they all compete differently, right? If I look at the common trait with all three of the business lines, payments and transactions. Payments and transactions, okay? That's where all three are kind of line up, right? PayPal competes more with the consumer, but also small, mid, and large size companies use PayPal, right? That's huge. I mean, if you go to a lot of retailers' checkout pages on e-commerce, you're going to find an option to pay with PayPal, right? If I think about Venmo, very consumer oriented. Now, I do believe Venmo is going to become much more important to small and mid-sized businesses over the coming years, but right now it's very consumer related. If you go to a college campus and somebody needs to transfer somebody money, they're using Venmo, okay? Braintree, on the flip side, this is the back-end service, so you can run transactions and whatnot. And Braintree really competes with mid and large companies. Like that's who they're trying to grab. They're trying to grab the company with 1,000 employees, 10,000 employees, 100,000 employees, big companies, to use Braintree as their payment processor and their kind of back end when it comes to anything payment related. Okay, so these companies are magical, and what makes PayPal and Venmo so magical is two things. Scale. Both of them have scale. They're both of the most downloaded apps on a given day and the most used apps in the finance category day in and day out in the United States of America, and PayPal's huge worldwide as well. So do keep that in mind. Whereas Venmo is really United States based, PayPal's massive around the world. Like PayPal's number 5 most popular finance related app pretty much in almost every developed market you could possibly imagine. So scale makes the magic with these companies. The second component is convenience. Convenience. These companies make your life easier. I mean, I know there's so many purchases that, when I'm checking out at a website and it gives me that option to pay with PayPal, I'm like, heck yeah, because then it just scans my face and then it's just everything's through. I don't have to worry about entering my address. I don't have to worry about entering my phone number, my email, my name, the credit card. I don't have to worry about any of that. It's just boom, it's all done right there, okay? Scale and convenience is everything, and that's why PayPal and Venmo are so massive, okay? Now, when it comes to Braintree, what makes this magical is two things: more conversion and more convenience if you're a business. If you use Braintree, you're going to be able to convert higher, and you're going to basically make your customers' lives easier. And if you make your customers' lives easier, you're going to have more conversion. Like anybody that runs a business of any kind, you know this, right? And so when it comes to Braintree, they have it so you can pay with Visa, MasterCard, American Express, Apple Pay, Google Pay, Venmo, PayPal, Buy Now, Pay Later, Visa checkout, MasterCard checkout, Samsung Pay. You can pay any way, which is magical because nowadays especially, people like to pay different ways. Not everybody wants to pay with a Visa credit card. Not everybody wants to pay with an American Express credit card. Not everybody wants to pay with PayPal. Not everybody wants to pay with Apple Pay. Like, people love to pay with a lot of different ways. And so Braintree can make you, as a big business, be able to have all these different options. So whatever way your customer wants to pay, if you're Uber Eats, if you're DoorDash, whatever, your customers can pay that way. That's magical, okay? PayPal has a good balance sheet on this company, almost $7 billion in cash equivalents. That number's probably going to be bigger, but then again, they are doing share buybacks right now, so it could decrease. We'll see. $4.7 billion in short-term investments, another almost $4 billion in long-term investments, and they have about $10.5 billion of long-term debt on this company overall, for total equity of right around $20 billion for the company overall. Now, here's the deal. We're buying PayPal for the future, right? And the future is looking pretty dang good for PayPal. Analysts have the company growing EPS about 12% this coming year in 2024. I think they're probably going to beat that. But even if they only did 12%, which is, by the way, is a very impressive number, that puts them at a 10 PE based upon next year numbers. Like, that's ridiculously low. That's way too low for a company like PayPal. It's insane. As far as their revenue growth goes, 8.7% expected. Don't be surprised if they outgrow that number. You've seen some of these Black Friday numbers, these Cyber Monday numbers. Wouldn't be surprised if they outgrow that quite a bit. And especially if the consumer's in a better spot next year because of inflation coming down. Here's the deal. PayPal's a cash flow machine. There's no debating that. And their cash flows are likely going to continue to build heavily in 2024 and 2025, right? Now, they can go ahead and use all that cash flow to do acquisitions or things like that. I don't think they really need to do that. They got PayPal, Venmo, and Braintree. I don't think they need to do any acquisitions. So what they can use that money for is to buy back more shares at very cheap prices. And anything under $100 for PayPal is extremely cheap. So they got a bit of time here to buy back as many shares as possible, right? Buy back shares at cheap prices, boost up that earnings per share, right? Because they're taking more and more shares off the market. And so it's a phenomenal situation, right? My prediction is in 24 to 36 months from now, everybody's going to look back and they're going to say, dang, man, remember when PayPal was a $50, $60 stock in 2023? We should have been buying it. That's my thought in regards to this. It might even happen next year. We might even be next year. People are looking back and saying, remember when PayPal was 50-something? I should have probably been buying some shares. Like, that would seem, I didn't realize how good of a deal that was on such a great company. Like, we had it, right? That's my prediction. So we'll see how it all plays out. I'm adding as many shares as I possibly can right now. I'm getting, as many shares maxed out, okay? And so that's PayPal stock. That's number 2. Number 3 stock of these 5 stocks up here that I'm going to be buying in December 2023 is Cheesecake Factory. So Cheesecake Factory starting to roll a bit. This one's up about 9.6% in the past month. Reason being is some of the small caps that started to show strength, and Cheesecake's under a $2 billion market cap, so it is a small cap company. It pays about a 3.5% dividend yield. So the nice thing is I actually just collected Cheesecake Factory dividend payments. I believe it was this week. Cheesecake Factory paid me out in all my different accounts that I own the stock in. So that's kind of a nice thing to just get that dividend cash flow and see it in your accounts, okay? Now, when it comes to Cheesecake Factory, obviously, super famous restaurant brand in the United States of America. I think if you live in the United States of America, you've probably seen Cheesecake Factory before. You might have eaten at it before, okay? Huge menu. They're known for their massive menu. They're very dominant in the U.S., but they are starting to build their business internationally in the Cheesecake Factory. They're starting to build a decent amount of locations in the Middle East, which they have a lot of room for growth there. Starting to build some locations in China, which they have a lot of growth ahead in China, and building some locations in Mexico as well. If I really think about the market that could be massive for Cheesecake Factory, I really think about China specifically. I really think I don't know, man. I don't want to get too bullish on China, but there is a potential like Cheesecake Factory long-term could be bigger in China than the United States. And that's just, today it's not even remotely close. No, on top of that, they have this massive growth opportunity. So Cheesecake Factory really has a lot of growth opportunity internationally, although they are still building locations in the United States. It's really international. But they also own North Italia, which North Italia is phenomenal Italian food, actually some of the best Italian food you'll find anywhere out there. And North Italia just has insane growth ahead. They put up these ridiculous numbers. People come back and they spend a lot on alcohol at North Italia too. That's a heavy part of their mix, which if you know the restaurant business, that's where the money's at, okay? People buy bottles of wine there. They love it. Absolutely love it, okay? They also own many of these other restaurant concepts, Blanco, Flower Child, Culinary Dropout, and many others. And if you live in Arizona or you ever go to Arizona, you can experience a lot of these. I have a house in Arizona, which right now I'm actually renting out that house, but I'm renting it out to somebody. But when I would spend a lot of time in Arizona, when we used to have a lot more time to go to Arizona, I would go to all these different concepts. I was so impressed by all of them. I'm like, damn, man, like they're packed. I'm like, these might have huge potential. This might be the next North Italia. This might be the next Cheesecake Factory. Like the concepts. I'm looking at this company. I'm like, they have 10, 20, 30, 40 years of growth ahead in all their different restaurant concepts. It's ridiculous, right? They're going to accelerate their restaurant openings over the coming years, which I think is a very intelligent decision. No, when it comes to company, their volumes are unmatched. Cheesecake Factory puts up the biggest volumes of anybody. They even beat Texas Roadhouse, which Texas Roadhouse, with how much volume Texas Roadhouse will move on a Friday night, Saturday night, it's ridiculous. And they actually far outsell even somebody like a Texas Roadhouse. Moderate check, average checks around $29 roughly at Cheesecake Factory, and they built their off-premise sales substantially. If you go back in the day, I would say off-premise, which is basically just selling to-go food, was a very small component of Cheesecake Factory, almost non-existent. And now, after Rona, it's a huge component of the business overall. Their latest quarter, they reported an A- income statement, which is very, very good. I graded an A-. They brought down a lot of their cost expenses in terms of percent of revenue. They were able to, they were able to get their income from operations to go up quite substantially, and that was at about $19 million. And they were able to have their earnings per share go up substantially versus where they were at last year. And keep in mind, that's all while, in Cheesecake Factory has been putting up these good numbers with inflation, right? And that causes inflation in wages, inflation in, obviously, the commodities that go into the products to make the food, right? And on top of that, you have inflation that you have to deal with your consumer, right? The consumer's been hit by inflation, which hurts business. So they've been putting up these very impressive numbers in a tough environment, man, very tough. And if you look at Cheesecake Factory, even in the great financial crisis, the company did tremendous. Look at the revenues, look at the profitability, even back in the great financial crisis. So this company's think about what they've weathered over the past 15 years. They weathered the great financial crisis and did just fine. They got through Rona, which was the worst possible situation where the restaurants were literally closed, like for months. That was crazy, right? They got through that. And then they've gotten through this huge 1970s-ish inflation that we just had to go through. I mean, you go through all that, you're an impressive company in the restaurant space, I can tell you that. And they've done it, right? No, here's the deal. Company trades at about 10 times expected 2024 numbers. They're expected to have about 17% EPS growth next year, about 6% revenue growth. I don't dispute those numbers. That's kind of what I'm expecting roughly as well. If they come in through and they beat those numbers, great. But I'm not expecting some sort of, huge up numbers. This is a sleep well at night stock. A sleep well at night stock. I can add Cheesecake Factory. I can collect my dividends on this. I think I'm going to get good share price appreciation over the coming years, and everything's beautiful in regards to that. So I love owning this one. I want to own a lot more shares of this one. And I'd probably be buying this one for at least the next several months. I would put it like that, okay? Alrighty, so that's the third stock, at least 5 stocks I'm planning on buying in December of 2023. What is the fourth stock? The fourth stock it's under $15 a share. It is Revolve, RVLV on this one. Had a very tough past 5 years, and it's had some huge ups and some huge downs in regards to this company, okay? They have 2 big websites that are known. One is Revolve, which, I know a lot of my audience is male-dominated. I think 85 to 90% of the people that watch my channel are males, which shout out to the females that also watch the channel, the 10 to 15% of you. But these websites are fairly popular with females specifically that are looking for clothes, okay, in e-commerce space and kind of a little bit higher end stuff. And so they have Revolve, and then they have their website Forward, which sells really, really high end, more luxury type items, okay? Now, in regards to these have had a really bad past year. Revolve sales were down about 2% year over year. Forward sales down 14%. Segment gross profit down 4% for Revolve and down 24% for Forward. So really bad 2023, okay? But if you look at what's going on Black Friday and Cyber Monday, I think there's a potential retail starting to come back. And if I think about inflation stopping to hurt the consumer so much, and real wages starting to tick up now very nicely, and I think they're going to tick up a lot more in 2024. I think 2024 is going to be a year where Revolve gets back on track, but also the retail space in general, because the retail space in general has just had a horrible 2024. If you look at these companies' numbers, it's been awful. Like everybody from the top to the bottom, it's been bad. But I do think things improve for all these companies in 2024 overall. So I do believe these weakness in the numbers we've seen in 2023, I believe this is a 2023 specific thing, and I believe in 2024, it's a whole different ballgame. We're talking about growth, okay? Now, despite this really bad year, okay, it's still been a cash flow beast. If you look at the 9 months of 2023, still $47 million of net cash provided by operating activities, and then free cash flow. So they're still putting up a 21% CAGR in the past 4 years, compounded annual growth rate, right? $44 million in the past 9 months alone. So even in a bad year, it's still a cash flow beast. That's what I love to look for in companies. Remember, I just spoke to you about Cheesecake Factory, right? Going through the great financial crisis, going through Rona and the restaurants being closed, and going through the super high inflationary environment, and still making it through and still being a stronger company emerging out of that, right? I look at a company like Revolve, and it's showing me the exact, very similar characteristics of being able to go through hard times and make it out the other side and still be profitable and still be a cash flow machine, right? No, the balance sheet's ridiculous for this company. Here's the deal. They have around $400 million roughly of stockholder equity. They have around $266 million of cash and cash equivalents alone, right? And the market cap's less than $1 billion on this company overall. So I think I'm getting a pretty steal deal on Revolve overall. No, they're expected to do about 51 cents of EPS. I think that number could be low, which would put it at, by the way, about a 26 forward P for next year. I think the number's probably low. And the reason being is analysts only have the company growing 4% revenues. I think revenue growth is going to be a lot stronger than 4% in 2024 for the company. So I think their revenues are going to come in much better than expected throughout 2024, and that's ultimately going to make their earnings per share much better. And I think, honestly, I think the last quarter of 2023 is going to be a lot better than people anticipate. So I think they're going to beat on revenues and EPS for this last quarter as well. So do keep that in mind, okay? So overall, in regards to Revolve, I own about 3,000 shares of stock right now in the public count. I would love to get to like 10,000 shares or so of Revolve overall in the public count someday. Like, I hope to get it there someday. I like the CEOs of this company. I like the business model. Yeah, man, that's the fourth stock, okay? Fifth stock, last one of the bunch. And I really love this one, and I'm buying it right now, and I'm buying it pretty heavy right now in the Patreon portfolio also. And that stock is Wynn Resorts. Winning Resorts, okay? Number 5 of 5. So when it comes to Wynn Resorts, this is a stock that's been through a lot of ups and downs, but a lot of downs over the past 5 years, right? It's down about 14%. But here's the deal. They went through all the negativity with China, right, which Wynn's an American company. The stock's in America, but it's seen as kind of a Chinese company a little bit because they get so much of their revenues and profits over time from China. So they had to deal with that negativity around the U.S.-China relationship. On top of that, Rona, right? Where all of a sudden, Macau was very limited in terms of being open for 3 years. Like, it's just finally this year that Macau's really started to open back up. So they had to deal with like the worst situation. And that's all behind them now at this point in time, right? They own 2 properties in the old part of Macau, the Wynn property and the Encore property. These are their old dogs in the area, which are very successful properties. They also own the Wynn and the Encore Las Vegas, which I estimate if we were to build those same properties with the golf course, with the water, with everything they got going on there, I think it would be over $10 billion nowadays. Back in the day, Steve Wynn built those. He was building those in kind of like 2000. I think construction started 02, 03. And this one opened about 05. And then this one opened 2009. And so I believe Steve Wynn built these for about $6 billion, but the cost of everything has gone up dramatically from kind of that mid-2000s time. So my estimate on what the land and the properties would cost nowadays, if you want to build the same thing on the same property, identical everything, probably $10 billion plus nowadays, okay? They own the Wynn Palace, which is their big beast in Macau. That's their granddaddy. That's their Bellagio there. And then they also have the Boston property, which is technically it's in Everett, Massachusetts, but it's right outside Boston. And beautiful property there. They do not own that property anymore. They're doing a sale leaseback of that property. But obviously that's a premier resort on the East Coast in general, right? Now, Steve Jobs, when he left Apple, he really set up Apple for the next 10, 20 years, right? And if you look at Apple over this past 10, plus years that he's been gone, it's just been about just executing as a company, right? You didn't have to change the game. It's just like he already set things up, just make the iPhones a little better, the computers a little better, the iPads a little better, like the App Store, he set it all up, before he passed away, right? And if I look at what Steve Wynn's done with Wynn Resorts, right? Obviously he left the company about 5 years ago for different reasons. He set the company up for the next 10, 20 years. Just to be honest. And all they have to do is execute. That's it. Like, he set the whole business model up in China, in the U.S., the properties, perfectly designed, everything. He set the company up for perfection. All they have to do is execute. So it's a very similar like Apple situation for this next decade or so, where all they have to do is execute and the stock should thrive and the company should thrive overall and the shareholders should thrive as well, right? Now, gross profit has gone up immensely here recently, and keep in mind the numbers are just going to keep pouring in because Macau's just continuing to really open back up in a substantial way. Gross profit, $429 million in the same quarter last year, and they just put up over $1.1 billion in gross profit, okay? Operating income went from an operating loss of $50 million to operating income of $268 million in this most recent quarter overall, okay? Here's the good buy prices for Wynn Resorts. Keep these in mind, okay? If Wynn goes over $200, that's a sell. Anytime Wynn goes over 200, it's usually an opportunity to sell because usually it's going to go maybe 210, 220, 240, 250, whatever, and then it's going to come back down. Because something's going to happen, a recession or something in China or whatever, okay? That's just the way it is. You can get the stock under $100, it's always a buy. And if it ever goes under $70, which is rare, but sometimes it'll go down to $50, $60 or so, that's a load the boat situation if you can ever get it under 70, okay? So those are the prices to kind of keep in mind there. Right now, obviously, the stock is under $100, so it is a buy, okay? I appreciate everybody joining me. As always, thanks so much for being here. Hope you enjoyed today's video. Thank you for being subscribed here, folks. If you're looking to apply, join my private group and get access to all my different courses, get access to the 6- and 7-figure Discord chat, access to see the moves I'm making in my nearly $2 million Fidelity account, and all that good stuff, then check out the pinned comment down there, and you can can apply. We can see if we can get you in there maybe next week or something like that, okay? Much love and have a great day.